Hi, everyone. I'm Michelle Jakubowska, Marketing Associate at Ramapo Wealth Advisors. Thanks so much for joining us today for our March 2026 market update. I'm here with Wealth Advisors James Sahagian and Alex Tierso, along with our Registered Client Service Manager Ian Bin Linson. All three are certified financial planners, and we're excited to have them here today. We'll be covering the major headlines from the past few weeks and sharing our team's perspective. We'll also be introducing Holistiplan, a powerful tax planning tool, and highlighting how it can uncover tax saving opportunities. So here's what we'll be diving into today. Updates on the Iran conflict, the disruptive impact of AI, and the broader economic outlook. Energy market impacts from the war, equity pullbacks, and why the market isn't the economy. Long-term investment insights and reviewing newly offered Trump accounts. And last but not least, highlighting Holistiplan and demonstrating how it can reveal potential tax strategies. So James, where do we stand with things today in the market?
Thanks, Michelle. And hi, everyone. Thanks for joining our team for our March market update. Today is Friday, March 27th, 2026, and what a month it's been. The last time we provided you a market update in February, on February the 6th, the Dow had just crossed 50,000 for the first time in history, and there was a much more positive feeling in the economy and in the markets. But as we sit here now, we're about 7 to 8% off the early February highs, and clearly the dominant story is the now escalating conflict with Iran and what that means, not just geopolitically, but also for inflation, the economy, and ultimately your portfolios. When markets think about geopolitical conflict, especially in the Middle East, the first and most immediate reaction is in oil prices. And that matters because energy is one of the most direct inputs into inflation. If you look at the inflation breakdown in the components of the Consumer Price Index, the most commonly referred to measure of inflation, you'll notice that energy has historically been one of the most volatile contributors to inflation. Even though inflation has come down meaningfully from over 9% in the summer of 2022 to roughly the mid 2% range recently, energy shocks can quickly reverse that progress. Here's why. Higher oil prices mean higher gasoline prices, which virtually affects everyone. Higher transportation costs mean higher goods prices. Higher input costs mean pressure on corporate margins and earnings. And most importantly, it also impacts consumer psychology. Consumers make up 70% of the U.S. economy. When people see gas prices spike, inflation expectations tend to rise, and even if underlying inflation hasn't fully moved yet. We've seen this movie before. Think back to the 1970s oil embargo. That triggered sustained inflation and ultimately forced aggressive Fed tightening. The Gulf War in 1990, oil spiked briefly, but inflation impact was short-lived as the war was very short. In 2022, just a few years ago, when Russia invaded Ukraine, oil spiked above $100, similar to where we are now, contributing to the inflation we just lived through in 2022. The key takeaway from history is this. Geopolitical shocks tend to be inflationary in the short term, but their long-term impact depends on whether or not they persist. If this conflict is contained, markets tend to look through it. If it escalates or disrupts supply meaningfully, that's when inflation becomes more entrenched. I'd also like to point out that the United States is now the world's largest energy producer and a net energy exporter, so it is much better positioned than it was in previous conflicts to absorb the worldwide energy shock that is being experienced due to the spike in energy prices. Now let's connect that to the market, both stocks and bonds. Higher inflation, especially driven by energy, creates a few challenges. It pressures margins, it keeps interest rates higher for longer, and it compresses valuations. If you look at valuations today, The S&P 500 is trading around 20 times forward earnings, which is still well above the long-term average of about 17. So the market is already priced for a pretty good environment. That means shocks like rising oil, the one we're going through, tend to create volatility, especially in higher multiple sectors. As far as bonds are concerned, on the fixed income side, the story is pretty straightforward. Higher inflation means higher yields. Higher yields put pressure on bonds. We're currently at around 4.4% on the 10-year U.S. Treasury, which is actually not historically extreme, but it's higher than where we were just a few years ago and even a few months ago. The good news is that starting yields are now much more attractive, which improves forward return expectations. Interestingly, not all sectors are hurt equally. Energy prices and energy stocks have often or have benefited from the spike in oil. Defense stocks have also seen inflows and appreciation. Yet technology and growth stocks have been more sensitive and under pressure due to their higher valuations. So you're seeing more dispersion under the surface, even if the index doesn't move dramatically. So the bottom line here is geopolitical events like this don't just create headlines, they create ripple effects through inflation, interest rates, and valuations. And that brings us to the second major theme I wanted to touch on, which is artificial intelligence.
That's really interesting, James. Even before the war, there was already some anxiety about how changes in the economy and different industries might play out due to AI. So, what can you share with us on that?
Artificial intelligence is not just a theme, it's becoming a foundational shift across the global economy. If you look at corporate behavior, the data is pretty clear. Major tech companies, what we call the hyperscalers, are dramatically increasing capital expenditures, with spending expected to grow into the hundreds of billions of dollars annually over the next few years. At the same time, adoption is accelerating. A growing percentage of companies are now using AI in business functions. Candidly, I used it in preparation for today's podcast. And many large enterprises are already deploying AI agents in real workflows. This isn't theoretical anymore. It's happening. But here's where it gets interesting and where I've been getting a lot of questions. If AI is so powerful, why are certain sectors like enterprise software under pressure? There are a few key reasons. AI is compressing the value chain. What used to require large software platforms can now be done with AI copilots, automated workflows, or even direct model interfaces. In just the last decade, we've gone from software as a product, on-premises, priced by licenses, with a growth curve that was episodic or staircase, to software as a service located in the cloud, priced by the number of seats that a company uses, with a growth curve being a linear ramp, to agentic, software as a worker, priced based on outcomes, tasks, agents, and usage. The growth curve here is an exponential ramp. That raises a real question. Do companies need as many software tools as they used to? While in some cases, the answer to that will be a clear no. Successful companies which have become AI native have integrated AI into their products or services to enhance their value. AI has reduced the switching costs to commoditize certain services, putting pressure on pricing power of many legacy software companies. Spending is shifting away from traditional software licenses towards AI infrastructure, chips, and cloud capacity. So even if tech spending is growing, it's being redistributed. So the key question becomes, is the decline in areas like enterprise software justified? I would have to say partially yes, but not universally. This is where valuation and dispersion matter. If you look at the market today, there's a wide valuation spread between companies, and growth stocks still trade at a significant premium to value. That tells us something important. The market is no longer rewarding growth at any price. It's rewarding durable growth with clear AI integration. So companies that leverage AI to improve margins, embed AI into their products, or benefit from AI infrastructure, these companies are likely to continue to do well. Others may struggle, and that's why you're seeing more differentiation within sectors. So as we step back and look at everything together, geopolitics is creating short-term uncertainty, especially through energy and inflation. Markets are adjusting to a world of structurally higher interest rates, and at the same time, AI is reshaping industries in real time. For investors, this is a more complex environment, but also one with more opportunity. As always, the key is staying disciplined, diversified, and focused on long-term trends rather than short-term noise. Thanks for your time, and I look forward to seeing you next month.
Thanks, James. With everything going on, it can make people wonder if now is even a good time to invest. So, Alex, how do you think about that from a long-term perspective?
Thanks, Michelle. And yes, it is obviously concerning to maybe put money to work or to invest during a military conflict like we are right now. And unfortunately, we never get that all clear sign, hey, the water's warm, come jump in. By the time that's happened, it's usually already too late and the market has moved rapidly. So what we're showing in front of you right now is what would happen if you invested halfway through a downturn. And we have 5 historical samples in front of us looking at the 1987 market crash, the 1991 Gulf War, 2001 tech wreck, the 2008 global financial crisis, and 2020 COVID-19. And finally, all the way to the right, just an average of those scenarios. And what you'll find is, even if you invested halfway through the downturn, you still would have been in a significantly better position 10 years later, right? So the average, if we look all the way to the right, would say that you might have 19% more downside, additional downside, if you invested halfway through a downturn. But if you look over the subsequent 10 years, you would have nearly 3x'd your investment, which is way above the historical averages of the S&P 500. And that's what we're measuring in this slide here. So I don't know if we're halfway through the downturn of this Iran conflict. I know we're no longer at the start of it. I know rhetoric on publications has said that they're trying to tame things. Who knows? We'll see how this plays out. But the overwhelming majority of historical examples have shown us that putting money to work during a downturn leads to very strong long-term results. And I just want to kind of piggyback on that. And what if you did put money to work during the downturn, but even worse, you put your investment in lump sum the evening before a downturn began? And in this scenario, we're looking at having invested $100,000 on October 18th, 1987, the day before Black Monday. You would have woken up or you would have seen that evening that your balance would have dropped to $79,500. So you would have lost almost 21% in one day. That's terrific. That's horrific. Sorry, not terrific. And alternatively, if you had invested $1,000 for 100 months, so the same $100,000 balance, you would have bought in subsequently at a lower price after it had fallen, and in the ensuing 99 months, dollar cost average into the market. As you can see, it's generally in your favor to do a lump sum investment because over the long run, markets are your friend. The trend is your friend as it goes upward, even if it is right before a huge market pullback. So I know it's concerning to invest during market turmoil. We do, as human beings, always try to, time things because we're looking out for ourselves and we want to make sure we're getting in at the best point in time. But it's not easy. Experts across the industry can't even market time effectively. So again, we share these charts and slides with you to kind of help you stay invested and continue to invest over the long term. Next slide, please. So Trump accounts were just introduced to us last year via the One Big Beautiful Bill Act that was signed into law on July 4th, 2025. And they are making the first contributions eligible or available at the 1-year anniversary. So July 4th, 2026 is when the first contributions to Trump accounts can be made. So who can contribute to a Trump account? So first off, if you have a child born in the calendar years of 2025 through 2028, they will be eligible for a one-time $1,000 contribution from the government. I had a son born in November of 2025. You simply go to trumpaccounts.gov and you'll input your personal information, their personal information. And on July 4th, they should be contributing $1,000 on their behalf. Beyond that one-time government contribution, individuals, family members, friends are able to put $5,000 per year of after-tax money into a Trump account. How do these accounts work? They function quite similarly to traditional IRAs. So every year you're able to put $5,000 into this account, and that money will be invested into a pre-selected list of low-cost index funds or ETFs that they're still deciding on. And that investment can grow over what they call the growth period, which is from your initial investment until the child turns age 18, the calendar year in which the child turns age 18. At that point in time, the child is now the owner of the account, and it essentially turns into a traditional IRA in terms of its rules, even though it will continue to be called a Trump account. The child can make withdrawals at that point in time. The child that's now an adult can make withdrawals at that point in time, and they will be taxed according to the same rules as an IRA rule. So if you're age 18, you have not met the age 59 and a half requirement. So it will count as an early withdrawal, and you will be taxed the 10% early withdrawal penalty, as well as ordinary income taxes on the growth component, on the investment earnings. Your after-tax contribution, which is known as basis, will be able to be withdrawn tax-free. So if you did $5,000 per year over an 18-year period, that would add up to $90,000 of basis in the account, plus whatever the investment earnings would have been over that time frame. So when I look at these relative to other options available to children, it really, has most things when it comes to financial planning. It depends on what your goal is. These are much more retirement focused as opposed to educational focus. So, comparing these to 529s probably it wouldn't be a fair comparison. 529s allow for a lot more flexibility to be used early on in life for even pre-university education. And they have increased the flexibility that 529s will be eligible to be converted to Roth IRAs as long as they've been held for at least 15 years. So I do still think, despite these new accounts being introduced to us, it really all depends on what is your goals. If you have a child born in those 4 years, 2025 through 2028, absolutely take advantage of the free $1,000. But in terms of you contributing the $5,000 thereafter, have to see, maybe after you've filled up a few other buckets, it may make sense. But until then, I think, you might want to have that discussion. Who else can contribute to these beyond you? Employers will be able to contribute on behalf of their employee who has a dependent. They can put up to $2,500 per year. That would count towards the child's $5,000 annual limit. And if you are living in one of those few zip codes or states where Michael Dell or Ray Dalio said they would contribute, that is, of course, also eligible. And that's called a qualified charitable contribution that would come from them. Other things to note on these, where can these be held? It's still being determined which custodians will be able to hold the Trump accounts. So no information on that at this point in time. And you can change from trustee or custodian to custodian, essentially doing an account transfer once those do become available. So if you do have any questions on these, or if you are considering them and want to weigh out, does it make sense for you versus a 529 or a UTMA account, feel free to reach out to us and we'd be happy to help you work through that decision. I'll pass it back to you, Michelle, for the final portion.
Thanks, James and Alex, for all of those insights. I'll now pass it over to Yan, who's going to walk us through Holistiplan and share an example of the kind of tax report that it can generate.
Great. Hi, everyone. So today, I want to spend a few minutes diving a little deeper into a valuable service that we provide here at Ramapo Wealth Advisors that's available to all of our clients. Tax planning using Holistiplan. When most people think about taxes, they think about filing what already happened last year. But in our practice, we approach taxes as an ongoing planning opportunity. Holistiplan allows us to take a client's tax return and turn it into something much more useful, a forward-looking planning report. So instead of getting lost in the complexity of a tax return, we're able to step back and focus on a few key concepts that really drive decision-making. So here on the screen, you can see a sample of a tax report from Holistiplan that contains many useful insights extracted from a tax return. One of the first things that we see is how income is being taxed. As you can see on the tax breakdown chart, not all income is treated the same way. For example, wages and business income are generally taxed at higher ordinary income rates, while things like long-term capital gains and qualified dividends are taxed at a lower rate. By breaking income into these categories, we can have more informed conversations around tax efficiency, like how investments are structured or when it may make sense to realize gains. Another important part of the report is understanding marginal tax brackets. A lot of people think that once you hit a higher tax bracket, all of your income is taxed at that new rate. That's a common misconception. In reality, it doesn't work like that at all. Taxes are progressive, meaning your income is taxed in layers. So different portions of your income are taxed at different rates, and only the dollars that fall into that higher bracket are taxed at that higher rate. Let's take a look at the sample report we have here. In this example, we see it on the left side that the marginal bracket for this tax return is 22%, but the average tax rate is only 13.2%. This is because your income isn't taxed at one flat rate. On the right-hand side of the slide, we can see that the income is broken into layers. The first $23,850 is taxed at 10%. Then the next portion from $23,850 up to $96,950 is taxed at 12%. So by the time you reach that 22% bracket, a significant portion of your income has already been taxed at those much lower rates, bringing your overall average tax rate down. So the final layer in this example is taxed at 22%, which is about $54,900 out of the total income of $151,000. And that's where planning becomes really valuable, because we can clearly see that remaining space in that bracket. So we can make informed decisions about whether to add income this year, such as through a Roth conversion or realizing investment gains, while staying within the same 22% rate. It essentially gives us a target range to work within. We can fill up that bracket intentionally without spilling over into a higher tax rate. On the other hand, if the client were already near the top of that bracket, we might take the opposite approach and look for ways to defer income or increase deductions. So this visual really highlights an important concept. Tax planning isn't just about what bracket you're in. It's about how your income flows through each layer of the system and how we can manage that strategically over time. The tax report also helps us to identify planning ideas and potential risks. That might include ways to shift income between years, evaluate retirement account strategies, or identify situations where adjustments to tax withholdings or estimated payments may be appropriate. What clients benefit most from this service is clarity. tax returns can be dense and difficult to interpret. This process helps simplify that complexity and turn it into actionable insights. So instead of simply reporting on what happened, we're able to focus on what we can do going forward. And lastly, I just want to emphasize that this is a service we provide to all of our clients as part of our overall planning process. It starts with simply sharing your tax return with us. And from there, we're able to incorporate the analysis into a broader conversation that we're already having. It's one of the easiest ways to let us identify meaningful planning ideas and help you make more informed financial decisions moving forward. And that's all I have today. Back to you, Michelle.
Thanks, Ian. And thank you to all who tuned in to our March monthly update. If you have any questions, please feel free to reach out to your advisor and let us know if you'd like us to send over today's slide deck. We really appreciate you tuning in and hope you have a great rest of your day.